Let's see. All right, we're live. This is CRInvestor, the Canadian Rational Investor. Brian Beamish here, back again. Tonight, Monday night, March 31st, 2014. Typically Mondays, if we look at our programming calendar, Mondays is the Chasm and CR, and whoops, I gotta turn off the, let's turn that off. So again, we're still very much in beta here, and you're gonna find little quirks and quirks along the way. Oh, now I hear messages coming in, so it sounds like people want to be invited to the show. Let's see what we got here. All right. So bear with me as we sort of work through the kinks, but basically, let's see if I can move this over here for you. Put you here, and you up here. Hopefully you can all see this on the screen now. Let's see if you can. Good. My goal is to basically provide content on a daily basis. Mondays are, I've slotted here Options Monday, or Power Options Show. Another user at TradingView, which is a site I like for charts, is also very active in the options market, and he and I sort of put our heads together, and we did what I thought was a very good inaugural show last week, looking at an options play on the National Bank of Greece, I believe it was, and you can look at the Twitter feed for that. So as you can see on Mondays, here it is, Monday 31st of March. It's about 5 o'clock, 5:28 right now, and we are doing the CRInvestor and Chasm Power Options Show. A little bit about who I am. My name is Brian Beamish. You can learn more about me, the Canadian Rational Investor, at therationalinvestor.ca is my website. It does kind of look like it's from the 1980s. I am an 80s guy, I guess, but I wrote all of the code by hand. And I'm very proud of it, and it seems to do the job. You can learn a little bit about me by going to my About Me page, where you can learn all about the adventures and challenges that my son and I are going through right at the moment. You can also learn a little bit about my professional experience on the website itself. I was a broker for quite a few years. Stocks, options, commodities, bonds, you name it, I basically did everything. I got the professional designation in Canada, and what I would sort of consider my professional peak back in 2005 when I passed the Fellow of the Canadian Securities Institute designation. And I'm very proud of that. Basically, I left the securities business in itself to look after my wife when she was ill. And sadly, Jojo, I love you so much, but she passed away from her sickness ultimately. One of the reasons why I like doing these sort of outreach programs, educating, is because I really like to give back to the community. I teach tennis on a part-time basis. I've taught in all the community centers in the Lower Mainland here in Vancouver, as well in a lot of sort of inner-city schools where kids normally just wouldn't get an opportunity to learn something like tennis. So that talks a little bit about my character and who I am, my professional background. What is rational analysis, you ask? Rational analysis is, in essence, the midpoint, as you can see on my moniker here. The midpoint, or the intersection, let's make sure we are looking at the right page, good, between fundamental analysis and technical analysis. So if we look at my little moniker here, we can consider the red circle as sort of the fundamental group, and the green circle as the technical group. And ideally what we want to do is find trades that where both camps overlap and they agree. That's basically the term rational analysis, and it was coined by a gentleman by the name of John Bollinger back in the 1980s. So with all that said, let's see, do we have somebody that's popped in? Haven, did you have a question? No? Okay, I'll continue with the presentation. That's my introduction about who I am. You can find the tutorials link. You'll see that every day I do individual tutorial sessions as well as these shows. So if you are interested in talking to me one-on-one and asking me a question, that's basically what it's all about. Feel free to inquire. I'm here to help. Moving on to today's topic in particular, Mondays are the options power show, and I'm just going to switch screen shares here so you can see a different screen, so bear with me here just a moment. Okay, I just have to make sure we pull up the right screen here. Let's try this one, see what happens. Good, okay. Today's show is specifically about one sector of the market that has caught my attention, that being Brazil. The reason why I actually got interested in Brazil at all to begin with was because of my WDB options model screen. And as I said, today is all about options, so you're going to hear me talk lots about options today. But basically, this option model, its function is to, number one, hunt the market for deeply discounted stocks, basically what you would call value investments. Obviously, there's going to be a bunch of negativity around a lot of these names. That's unfortunately a lot of the only way to get price to move down. If everybody's positive about something, price is usually moving up. So this model in particular, aside from the options component itself, its basic tenet is to look for stocks with extremely low valuations. Every single day it's scanning the market, telling me if any stocks in the broader universe, and this covers over 10,000 issues listed in the United States, whether they meet these criteria. So some of the criteria that I really I focus on, companies with earnings. I like to make sure that they have earnings, and I like to make sure that they're trading at less than 10 times earnings. Next category is book value. I like to find companies that are trading below book value. In essence, a stock, the only reason for its existence is the concept that money put to work through a growth venture will earn an income. So by definition, stocks should not trade below book value. They should trade to a premium to book value, because the companies are earning money. They have an earnings stream. So it's an excellent tool for stock investors to pay attention to what the current price of the stock is in relation to the actual book value of the company. What do we mean by book value? Book value, quite literally, is if you took all of the assets of the company, line them all up in a row, mark them all to market. That pencil is worth 15 cents. That desk is worth $5. That, or $25. That car is worth $5,000. That piece of property is worth $500,000. That industrial equipment is worth $750,000. That mine is worth $4 million, etc., etc., etc. If you take all of those assets and line them all up, and basically mark to the market and give them a fair value price, that is the book value of the company. And in stock market land, we always talk about book value per share. So you will see quite often, and those that have taken any of my other seminars or read my courses, you'll see that I like to use this site FinViz, and we'll just pull up any old company. Here's IBM. I make constant reference to these valuation models. In IBM's case, right now, the book value, if you took all of the assets and lined them all up against each other and marked them to market, it would be $21.25 per share. Currently, the stock is trading close to $200 per share. This, in my opinion, is not a value investment. And it's interesting that FinViz themselves has this price to book ratio, 9.106, and it's in red, right? Red's usually a bad color. PE on conversely, that's green. That's usually a good color, and frankly, that's pretty good PE. So, expensive stock making money. Is IBM the focus of our study today? No. What I'm always looking for when I'm thinking about the particular option strategy that we're going to look at today, initially, is deep value. All right, so going back to the screen results, the last component is I like to see a company with a whole bunch of cash on the books. When a company has a whole bunch of cash on the books, it means that they can ride out a few quarters of maybe disappointing earnings or negative sentiment, if you will, towards a certain sector. For example, a lot of the molybdenum companies have come up on the screens over the past year or two as metal prices were quite depressed. And that's just purely a function of the metallurgical coal market just being flooded with supply. So if you concentrate on companies with a whole bunch of cash on the books, then that means they can service debt, they can pay dividends, they can pay salaries, and survive. And the basic premise in our business is that these things move cyclically, so there are always brighter days ahead kind of idea. If you are buying assets that are below book value, then you can take that risk. And if they have a whole bunch of cash on the books, then sometimes you can get a situation where a huge component of the actual book value that we're looking at here is actually made up of cash. It's actually money in the bank. So that's an added kicker why we have that stringent cash requirement. The options model that I run an algorithm specifically for put writing. When you talk about options, you can do one of two things. You can you can trade one of two vehicles. You can either buy a call option, which makes money when the market goes up, or you can buy a put option, which makes money when the market goes down. By all means, if you are interested in learning about options themselves, I would highly encourage you to visit the Chicago Board Options Exchange website. They have lots of tutorials and lots of educational material on how options work. Long and short of all this is I was an options broker for a number of years, so I've been at this game for quite a while. So getting back to our model, the basic notion here of this particular model is that institutions write more than 90 to 95% of all puts in the marketplace. Retail investors are very reluctant to get involved in that field, and frankly, I think that the industry has built up a number of barriers that make it very difficult for the retail investor to get involved in this field. So, whether it be the media talking about derivatives risks, or whether it be the fact that you have to actually post additional margin after you've written the option, so it's not like it's just free money. You actually have to put a little bit more up ahead. But the long and short of it here is, if you actually do the math and you meet the requirements that the exchange is post, which is just strictly monetary function, there is a whole world of opportunity out there. This model in particular, its basic thesis is that when you write a put option, basically you are going into the marketplace and saying, I want to buy this stock. Keep in mind, we're concentrating on deeply, deeply, deeply discounted stocks. So, with the premise that we want to buy this stock, we constantly shop the options marketplace, and keep in mind that if you write a put option, not if you buy it, if you write it, keep in mind that with options there's two transactions on every deal, right? An option is basically an insurance contract between two individuals. There's the insurance premium payer, or the buyer of the insurance policy, and then there's the writer of the insurance policy. And you can think of your home insurance, your car insurance. It's basically the same thing. It's just these are insurance policies on stocks or commodities or currencies, whatever. It's basically the same philosophy. So this model basically looks out into the marketplace and says, if I want to buy a stock and I'm willing to hold that stock on margin, there will be a specific margin requirement asked of me by my brokerage house. That margin requirement is usually about 30% of the current price. So if we take a look at IBM, for example, 30% of 192, well, there's a number for you. I should have probably picked a cheaper stock, right? But for demonstration purposes, we're working with IBM. So 192 divided by 30. Let's try that again. All right. All right, just simply put, 30% comes out to roughly 60 some odd dollars. So your brokerage house is going to ask you, in fact, why don't we give you a hard number there instead of just mentally thinking it. The price at $192 times 0.3 comes out to $57.60. If I could have a situation where I actually got paid, right? The brokerage house is going to ask me for $57.60. If I could find a situation where I could get paid that what was that number again? $57.60. If there was a situation where I could go get paid that $57.60, then technically it hasn't cost me anything to actually put the position on. The margin requirement will be set at your purchase price. So if the price of IBM goes down, well, you still have to post that original margin requirement, but as long as you don't use the IBM itself as the margin instrument, let's say you had a bond or something sitting in your account, as the margin instrument, then the price of IBM itself is quite irrelevant to what that margin requirement is. The brokerage house will constantly come back and say, we want 30% of the original purchase price, plus interest, of course. So, with that concept in mind, the WDB options model basically goes out into the marketplace and says, are there any situations, using our IBM example, are there any situations where we can actually get the market to pay us one of these put premium buyers, right? Because remember, an insurance policy, there's two sides. There's a buyer and there's a writer. So we're going to be the writer here. They're going to pay us that $57.60. We write the put option, and in essence, the put buyer at any point in time has the right to force us to buy that stock. And in this example, we're just assuming that the strike price is the current price, $192. This algorithm itself literally hunts the market constantly for situations where not only do we get the entire margin requirement paid, but we actually get a little bit of a premium on top of it. So as long as we hold the position on margin in our account, remember, we collected, and in this example, if you look at the PWRD at the bottom here, we collected $6.04 in premium, and yet the margin requirement asked by the brokerage house is $5.40. So in essence, if you hold the position on margin, you're literally getting paid to do that. So that's basically the premise of this model. It assumes that you have a solid margin base to work with, like I said, either a big ETF or a bond or something that really isn't going to go anywhere. And that's what you use for margin. You don't actually use, in our case, in our little example here, we used IBM. You don't use that for the margin. So I hope that that explains it. It's a very advanced concept when it comes to options trading. But it works, and it's absolutely fantastic to watch it in action. All right, so that sort of brings us to what we're going to talk about specifically today, and that is I am very interested right now in Brazil. Whenever, and that's probably not the best cover story, but I basically wanted to have something on my screen while I talk a little bit about the background here. Basically, whenever we have world athletic events, you often get an influx of capital spending by not only local governments, but also international investment. I use the 2008 Olympics as the hallmark of how all this works. But basically, China told the world that they were going to use those 2008 Summer Olympics as their coming out party. I look at Brazil, and we all know what a big bull market and so many markets that was, the whole lead up to it. You can go athletic event by athletic event through time, and you see time and time again this phenomenon. I personally went through it here in Vancouver. We had the Olympics here in 2010. And I saw it firsthand. I was in Los Angeles in 1984 for the Olympics there. Haven't really seen that much about the World Cup personally, but I believe that it's enough of a catalyst that it's sort of getting attention back to the BRIC nations. You may have heard that term before. But in essence, the second largest economy here in North America is, in the Americas, is Brazil. And the BRIC countries, Brazil, Russia, India, China, sort of were on the periphery of the G8 world for many years, and they often move in tandem. So, one might argue the saber rattling out of Russia is indicative of it trying to, move forward. That's a whole show for another day, I suppose. China's doing its thing. They're fairly closely tied to the U.S. Basically, Brazil, India, they've been in a bear market for quite a while. So, with the concept that we have a bit of a catalyst ahead of us here with this World Cup, and do we have maybe a different picture that we can show, or is this a video? No, that's just a video. And then, of course, throw a commercial in there. The point that I would just make is that it's often in these catalyst sort of events that stocks that have been just pummeled into the ground can often get a rebound. The easiest way, I suppose, for us to look at a proxy for a country like Brazil would be look at their currency. And we see, if we take a look at a little longer term picture, and let's make sure you can see the chart I'm looking at. Yep, okay. Longer term picture, the Brazilian real has actually been stuck in a bit of a trading range over the past while, which, from an investment perspective, in my opinion, is actually a good thing, because we don't want to be considered buying downtrending markets. We would rather be buying sideways to slightly upward pointing markets. And if you like the idea that this is a trading range, then you can make the argument that trading range strategies ought to be examined. And what we see is down in the sort of lower third of this trading range, double bottom type actions, and not bad momentum and money flow. And in the top part of the price action, we get double top type actions and negative money flow. The long and short of it here is that the indicators seem to be suggesting that we're turning up. Nice momentum cross. Nice little double bottom here. We might have to clean this up a little bit. That wouldn't surprise me. But what really jumps out at me here is the volume. Nicely well-defined double bottom. And you can see, the volume is coming in here. I'd like to see this volume a little higher. So we'll see how that goes. We want to see higher highs and higher lows. But the long and short of it here is the OBV, after spending quite a bit of time making lower highs and lower lows, is now starting to make higher highs and higher lows. So I'm encouraged by that. A simple technician, if we do believe this range is a ranging market, ought to be looking for at least a first stop target somewhere up in here, about the 50 level. And right now we're at 43, so that's 20% increase. But ultimately, just on a trading perspective, I really like a rally up into this area. So while we haven't completely turned the corner here, I believe that, with the World Cup and the wind at our back, this country does have a sort of window that we're going to see price appreciation, and it's my general feeling that we're probably going to move back up into this area. That's the currency itself. If we look at the country fund, we see very similar type action. So this is the Brazilian ETF. that trades on the Amex, I believe. EWZ. And again, if we're looking at this technically, once we start entering this optimal trade entry zone, I believe that we switch from being just an overtly bearish story to, all right, well, we're starting to find some value in here. It's not bad. Nice bottom on momentum. And again, what I'm seeing is good money flow. I know this is a weekly chart, so this week's just started, but solid green bars. I would ideally like to see this turn up. I'm not necessarily espousing the idea of buying into the Brazilian ETF in particular, but I think it's just good demonstration to see what sort of the broader picture is for Brazil itself. So we have an interesting potential rally just in Brazil itself, back to the 54 area. So, even an OTE setup, 42.5 up to 54, that's $14 on 42 is, it's 20, 30, at least high 20s. So there's definitely lots of profit potential there. Moving right along. So we've looked at the currency. We've looked at the ETF itself. And, again, if we're range traders, then we're probably looking for an ultimate rally back up into the OTE short sweet spot. And from that, that's a 50% gain. So that's a huge, huge run-up potential. So that brings us back to the WDB options model. As I said, we have, in my opinion, a global catalyst in the World Cup. We have what I believe the start of a half-decent little momentum turn here in the Brazilian currency. And if we look at this on a daily basis, you see it a little bit better. Nice little double bottom in here. Here's that 38.2 fib way up here. Here's that volume move. Here's the OBV. Momentum, still not stupid. Willie's not stupid quite yet, so probably still a little bit of room for him to go. Big concerned about the divergence here in the short term, so we might get a pullback here. But in essence, there's that 38.2 way up there. I suppose you could also argue on a daily basis, we probably ought to keep this level in mind. So that OT. So lots and lots of upside potential here and nice double bottom. So if we do get pullbacks down into the 41, 41 and a half, I don't mind the Brazilian real. That's not, in my opinion, a overly risky trade. Once the Olympics or the World Cup is over, that might be another conversation altogether. I think most of this will be baked in pretty quickly. Here's this Brazilian ETF, the exchange traded fund. And clearly you can see, and this is the daily chart, this is a significant battle area right in here. So any pullbacks down into this area are attractive. Nice higher highs and higher lows on momentum. Willie's still not overbought yet, so still some more room to run. And nice double bottom here, wide double bottom on the OBV. And you can see, look at all these green bars, buying, 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 and this thing's been on a tear. So that's review of that again. Now, I sort of backtracked there. Sorry about that. We'll get back to where I was. This brings us to the WDB options model. And that is that the WDB, as we said earlier, it specifically hunts for situations of really, really beat down stocks that have earnings that are trading below book value and that have a whole bunch of cash on the books. And lo and behold, what starts coming up? The first one that popped up on our screen, and this one came in a little while ago. But this is this Gavisa. And Gavisa is a Brazilian housing stock. Regardless of your feelings about Brazilian houses and the housing market in general, if you look at something like D.R. Horton in the States, and we'll just, while we're here, we'll just quickly take a look at D.R. Horton. How's it go, DR? Maybe they don't even exist anymore. How about Pulte Homes? Pulte Group, they're called now. Zim, zim, zim. Even through the absolute worst of the market, you can see that on a relative basis, this Pulte's come back from $3 or $4 all the way up to 24. So, this is just one housing stock in particular. D.R. Horton was one that I remember trading for a long time. I guess it's, maybe I've got the symbol wrong. I can't remember what it is. Maybe it's, oh, there it is, D.R. Horton. Haha. Same thing. So, big rally. And really what this is it's basically the credit market is getting cleaned up. So we look at Gavisa, and you can see that, like its brethren, it's trying to base. And, it's not an accident that, like D.R. Horton and stuff, they bottomed down in this area, because these are where, real book value was on these companies. So not a big surprise that they finally are starting to bottom. Technically speaking, just back in 2011, this stock was $18.50, and they took it all the way down to $2 and change. That's a pretty big haircut. And what I find fascinating is that the fundamentals on these companies start getting to such ridiculously compelling levels, it doesn't make sense not to own this. I mean, at $2 a share with 70 cents in cash on the books, basically, half of your investment is almost just buying cash, regardless of all the other assets that the company happens to own. The book value, it's 0.45. So basically, the company's assets themselves are twice what the current market value is. And they are earning money. It's not like these companies are not earning money. They're actually earning money and trading at phenomenally discounted levels. So it's just really a question of at some point the sector has to turn. There's got to be a catalyst for people to get involved. What I find very, very interesting is that the WDB options model itself usually spits up its signals when we get to these incredibly low valuation levels, because keep in mind, if you can hold a stock on margin, which almost all brokerage houses can, they don't have to pay cash costs. They can just hold the stuff on margin. You can literally get paid to do the transaction. So it's in even the brokerage house's best interest to take the opposite side of the trade. So in this example here, and this came up in June of 2013, so it's about a year ago, this was a $5 put option that was trading at $2.53. Keep in mind that the margin requirement to own a $5 strike is going to be 30% of that $5, or $1.50. So that literally means at $2.53, we're getting paid a huge premium to hold this stock on margin. The actual cash cost of owning the stock, if you did this put option, was $2.47. But keep in mind, I don't own the stock on cash. I'm more than happy just to keep it on margin. I've got my bond that's giving me my margin level. It's not going anywhere. The company's going to pay me a dividend to hold the company shares. And as I said, the premium collected, $2.53, is more than a full dollar over what the brokerage house is going to ask me to put up in margin to carry the position. So using put options, you can actually figure out where the street is going to put some sort of downside floor on these things. Because in essence, the street, they don't have to abide by the retail margin requirements established by the CBOE. All they have to, well, they have a different reporter that they report to, completely different, but they don't have the same margin requirements that retail people have. So, in this example, basically, I'm sitting here long. Cash costs $2.47, but my margin cost is $1.50. Even right now, the stock at $3.12 is a fantastic gainer. But because of these fundamental valuations, I'm more than happy just to sit in this stock. And basically, we've sat here for about 8 or 9 months, just twiddling our thumbs. The stock has generally been higher. We were exercised. We were forced to buy it. Now, where do I think this thing can go to over the near term? Considering the backdrop, World Cup, considering that the Brazilian real itself, the local currency, is moving up nicely. The net value of the company's assets are moving up because the Brazilian real is moving up, and they don't even have to do anything. But that's a whole other conversation. Technically speaking, I mean, you see this 200 periods moving average. That's obviously going to be a hurdle. You see this trend line up here. That's going to be a bit of a hurdle. We've cleared this traffic zone here. So really, my hunch is we could probably jump up into the 4.5 area fairly easily. I believe that this 38.2, and you've heard me make reference to it already, is really where this thing's going to in the short term. And at that point, this is basically a home run. And that's not even where I think it's ultimately going to go. If we look at OTEs, those in the investment community who want to be short this stock, these are the levels that they watch. And so if you look at GAFCA over time, you see that this is where the stock likes to break down. Broke down here. Broke down here. Big sell signal here. Right? So that, you know, very similar to this pattern. I think we go this way. Let's see. Yep. We rallied. This was the big dump. Here's the double bottom. Here's 38.2. We got fairly close to it. Here's the OTE right up in here. So I'm not saying that the street won't short this, but the street's not going to short here. They're going to be looking to short up here. And of course, you know, as a broker, and really this is how everyone should trade, considering our cash cost on the stock is $2.47, I would, if I was your broker, I would be pleading with you to let some go at 5. In essence, sell half on a double. Once you get your original money back in your hands, then basically this is a risk-free trade from this point on. So, is it realistic to see $5 a share on GAFCA in the near term? I think it is, given the macro events, given the world, you know, putting a bottom into their currency, and this currency looked like it's moving higher. Given that the ETF, that's basically a proxy on the country itself, it seems to be moving higher here over the short term. This is not a bad idea. Now, to leverage this play, I mean, we've looked at this short put strategy. Let's look at the other side of the equation, and that is the long call strategy. So right now I'm going to pull up a GFA options chart from the CBOE. Best place to go is the horse's mouth, as they say. And this is very interesting in that we were looking at this, and we call this TheChasm and CRInvestor's power options show, and Joe told me that he was able to go and buy a bunch of these at a nickel. This is the September $5 call option. You can see that the stock right now is the price $3.18. So an option that just even has a little bit of time, but it is slightly in the money, can actually be worth quite a bit of money. This is an April option, expires not a lot of time, and it's bid 45 cents because, in fact, it looks like it's a little undervalued because right now, and that's, I suppose, why they offer 75, but it's a little bit in the money, and it's, you know, a fairly respectable premium, 45 to 70. Keep in mind that when we first looked at this off of this nice daily double bottom here, let's pull up the daily so you can see what it looks like zoomed in. You can see that she's been chugging higher here for a while. We actually did put in a nice double bottom. This is the day when I actually republished this post and where Joe went and bought his nickel options. So even now, the option itself is a September $5 call. It's offered at 20 cents. He could throw his offer out there at 10 cents and he would be the offer, selling half of his position and basically get all his money back in his hands. Do I recommend that you go and, you know, pile a bunch of money in this option at 20 cents, which is the current offer? Absolutely not. That's very expensive, but you see that the bid is a nickel. No reason why you can't join that bid. Not a bad idea. I would prefer, to be honest with you, to be in a leap option, maybe something in January. But what's interesting about Brazil is it does, let's see, we can't really see it here. Seasonally, we went and looked back over it over time, and I think it generally enjoys a relatively good summer period, but we'll see how that goes. I think the World Cup here is the catalyst, and of course that's this summer. So GFA, this GFA, you know, just as one example of a Brazilian deep value stock, its natural retracement level suggests that. Well, that's weird. TradingView wiped out my fibs. Boo. Oh. Will they come back if I do that? No, they got, well, so there's that one still there. I don't know why they wiped this one out. But anyway, this fib right here, I guess is the one we were looking at earlier, suggests that $8.25 is perfectly realistic. Will it get there by September? That's another question altogether. And, you know, that's half of the game that we play with options, is it's all about time. At a nickel, I think it was an absolute steal. Not a bad place to maybe throw, like, you know, you could have bought 10 of them, excuse me, for $50. If you bought 10 at, you know, even if you paid a dime, paid $100 for them, if the market goes back to at the money, we saw that, you know, even a bit of premium, you'll get a little bit of a bid. This isn't really the best example for stocks because the strike prices are so wide, but it is nonetheless on the list, and I think it looks like it's moving higher. So I wanted to talk about it today. The next stock, which I think is just remarkable considering I literally put the stock commentary out on this bar right here. if we look back at the Twitter feed, and this is going back a bit, like 4 days, probably longer than that, I guess a couple weeks. PBR has been recently coming up on the WDB screen like crazy. And so that's why I was really excited about this one recently. And I'm just trying to find the chart for you here, so bear with me here a moment. And it's the specific write-up that I did on this that I'm looking for. Where are you? Where are you? Okay, what is that, 20th of March? I think it was actually longer ago than that. There it is, PBR. Alright, so on the day that I published this, our WDB options screen basically told us that we had a situation where a put option, if written, would give you more in premium than what the margin requirement is to hold the stock on margin should you get exercised. That happened to be right here. The option itself here is the criteria. So basically it was the $18 strike. So the option premium collected was $7.20, and the margin requirement to hold the stock at $18 or 30% is $5.40. So in essence, you got a 33% premium over what the brokerage house was going to call from you to hold the position. At the same time, the fundamental valuations were just ridiculous. I mean, every once in a while you run into these situations, and that's basically why I wrote this program, was that at some point these fundamental valuations get so dramatic that fund managers almost have no choice. They have to buy these things. So we see that the forward PE for this guy at this level, this was $10.80, I guess, was when I posted it. What does it say here? $10.46. The PE for forward was less than 5 times earnings. I mean, that's nuts. Price to earnings growth, 0.39. I mean, that should make growth investors salivate. Price to sales, 0.49. Again, that's phenomenal fundamental valuations. Price to book, 0.45, so basically trading half of book value. Price to cash, 2.65. So again, they got lots of cash on the books, and they can weather, a few quarters if the slugging's tough. But keep in mind, these guys, they're making money along the way. And oh, by the way, this guy paid you a 26-cent dividend to hold the stock. So if you had done the option put right, your cash cost on owning the stock is down here. Basically, the $18 minus $7.20 comes out to $10.80, right? Right down here, plus or minus commissions. You got paid a dividend, and then and technically, what is really interesting is, keep in mind, this is a weekly chart. We could see that it was this is just a sea of red, and OBV was just heading down and down and down. Nothing really to get too excited about here, but that often happens. Remember the GFA. The WDB came right in here, like right into the mess, is when the WDB options model told you. And again, look at Willie, nice and oversold. So, you're not... WDB options are not going to come up in bull markets. It's impossible. The only way you can get these put premiums to these exaggerated levels is in really bad bear markets. So in essence, Willie nice and stupid, the public is acting stupid, even a little bit of a bullish momentum divergence. And then I guess this is, so this was the original post, Willie stupid. Momentum, not really anything great. Volume, not really anything great. Fundamental valuation is just ridiculous. And then, right after that, you see that the stock just turned on a dime. And this is absolutely remarkable because, this is a weekly chart. If you pull up the daily chart on this, it's just been a straight up boom, 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 day after day. It's just incredible how powerful this move has been. All on big, chunky green bars, no selling anywhere in sight. And of course, going back to that weekly chart, we see that Willie basically is turning here. It was stupid oversold, so obviously we should have been paying attention. And now this is just the past 2 weeks. Remember, we were just looking at red, 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 and now we're starting to just power on the green bars here. Momentum, nothing really to write home about there in the raw reading, which leads me to believe that we're probably going to have a rally back a little bit, then come back down and test these lows. And if the lows hold, then we're good to go. If not, then we might have another down leg. That's another really good part about this is you see that the WDB gets you in basically down in the nice pivot area. So even if we did have to truck lower a little bit, even your cash cost is really not that bad. And keep in mind, the margin requirement to hold this stock is been paid. The margin requirement's already been paid with the option premium that you collected. You actually have a net credit in your account. Of course, now that the stock price has started to move up in earnest, obviously this option premium would have dropped dramatically. It'd be interesting just to see what it is trading at today. So this is the May 2014 $18 put. So I would say that the Gafisa is a great example of you actually getting exercised. We may not even actually get exercised on this option. The May $18 put right now, $5 bid, $5.40 offered. So as a trader, I mean, you collected $7.20. You got almost a 50% gain just if you went into the market today and covered the position. Well, I guess not 50%, eh? What is it? It's $2. So that's 30% gain if you just covered the position at the market. The irony of it all is that there's a very good possibility that we rally up to here. Here is the strike price, and frankly, we want to get filled. We want to get exercised on this option because we want to be owners from down here. But the irony of this option strategy is there's a very realistic possibility that if they take the stock above here before that May expiry, this option will expire worthless, and we just collect the $7 in premium, $7.20 in premium, and then move on to the next trade. But unfortunately, we're just not stockholders. We just collected $7.20 in free money. I suppose we could live with that. On the short term, where do I really think this thing can go? If we look at good old fibs, buy to low, you see that here's our OTE sweet spot. So the first stop target, $22. What a coincidence. That's right up against the 200-period moving average. This is what I really like this 200 weeks because I call this the business cycle moving average. And in essence, it's an excellent proxy for the business cycle. But you can see that 38.2 there is jumping out at us. With a cash cost, again, if we actually do get exercised, which I kind of hope, then our double is basically there. So once we hit this level, out goes half of the stock, and we're basically playing with the market's money. So that's basically what I see here. So ironically enough, and the sad part about it is, we're talking about in hindsight. Obviously, we can't roll the clock back, but this is a great demonstration of how the WDB options model, just the simple fact that these put options are trading at above the margin requirement required to hold the stock on the books, in itself is an arbitrage tool to, in essence, put a floor in stocks. And if you concentrate on stocks that are trading below book value at these levels, right, then basically this is a no-brainer trade. But, you can't be buying stocks like IBM right now that's trading at like 6 times book, right? That's where the danger comes in. So the reason why the WDB works so well is because we concentrate very specifically on stocks trading below book value, and with a whole bunch of cash on the books, with earnings, and basically with prospects going forward. Why do I have confidence in this company? Well, it is basically the state Brazil oil company. Are they going to go out of business tomorrow? I don't think so. You can dig into the story and find out why the stock prices come down. It's an interesting fundamental story, but long and short of it here, Brazilian real appreciating helps them a lot, and they're also expanding production locally, which is going to help their bottom line as well. So put it all together, first stop target 22.5, and ultimately your OTE short sweet spot is up in the $32, $33 area, and really that shouldn't be too big of a surprise. Remember we talked about, this is where the stock broke down originally. So if fund managers can get short, you notice how the stock rallied into that window and then failed. If fund managers can get short from these levels, this is the area that they want to be short from, not down here. Okay, just quickly, we'll finish off just with a long call look on the PBR, just to see what those calls look like. I did have a website that showed me charts on options, and so for future shows I'll have those charts on options available. Alright, so if we wanted to play this, this is a much more liquid market. I love the leap options. It's just me. Gives you a whole bunch of time. We said that the stock right now, and obviously it's had this makes you sick to your stomach. That's a 30% rise just in 2 weeks. 30%. Ay caramba. So we ultimately are looking for 22.41 here in the short term. I like the idea of trying to get long from about $11. I suppose if we looked at like a daily OTE, or like a 4-hour OTE, 4-hour chart, there's the rally there. So where to come from. If this is a short-term top, I can justify looking at it. Gee whiz, there's that $11.07 area again. So, if we can get back down into the 11, then probably a $15 call might be interesting. Remember we said that on the weeklies. On the weeklies, we got the 30 SMA here. That's at about 14 bucks. So we're probably going to run into a little bit of traffic here. So if we can get a pullback, that's probably your catalyst move through that high. So maybe like a $12, $13 call if we could try and sneak our way in there. $10 calls, a bit expensive. 13. This $15 call looks kind of attractive. Right now it's 85 bid, 90 offered. Look at the open interest. Obviously that's where everybody is. If we look at the put options, this is another really handy tool about puts. Remember, we said earlier, retail investors do not write put options. Institutions write put options. So if we see the heaviest open interest in these options is clearly this $15 strike, and it's also the heaviest open interest here just on this option series, the $15 call. This is where the institutions figure that the market is not likely to go out under. Keep in mind that if they can have this market on January, the third Friday of January 2015, if they can have the market close out at $15.01, then this 99,000 put options written expire worthless. So there's a lot of incentive by next January to have the stock above $15. And if you look in the shorter term, you can use this as a handy tool here. Heaviest open interest for the Octobers appears to be the 11. So it looks to me like smart money is expecting it above 11 by October. July, the heaviest open interest is in the 12s and 13s. Here just in May, again, there's the $15 again. So it seems to me that the street looks, it seems to me like they're thinking that this thing has got a nice floor developing around 15 bucks a share. Here just in April again, heaviest open interest in the 11s, which is interesting, but also there's again the 15. So put it all together. I might be inclined, if I was just playing the long calls, to take just keep on your radar screen this $15 call. Wonder what its price. Maybe it'll be half of that, maybe 2/3 of that price around. Let's see what the highs and lows of it are. So it's, oh, this is just today. Yeah, so this isn't the best. For future episodes, I'll have a better charting program for this, which will really give us a really good idea. But in essence, buying that leap, that $15 leap, is we're locking in a price on the stock for the next year at this level here. So we go to 22, and let's say hypothetically we paid, I don't know, we'll get a little cheaper than today. We'll pay 70 cents. Boom, done. So the $15 call, if any time over the next year we can get a rally back up to this 38.2 fib, which I don't think is too much to ask. Basically, last August, the stock was $25. So really, I don't think this is too much to ask to see a move in here. If we get 22.5, which is a tag of our 200 SMA, then this option has an intrinsic value of $7. So, 50 cents to $7, is that worth your while? Maybe throw, again, buy 10 of them at 50 cents. Going to cost you a grand total of, $500. You let 5 of them go at $1, and you see that even now $1 isn't too far away for this option. Where were we? The $15 call right now offers 90 cents. The next strike up is 155 to 160, so that's not totally unrealistic. But in essence, that would basically be something like in this area here. You probably get your dollar move. So, to get our fill, we're going to need a little bit of help here just in the short term. Probably going to be something like up to here, then down to here. That's where you would be buying, and then looking for, to sell half on a double there, then another pullback, and then ultimately into the summer, right? That's that August peak. Right up into the OTE sweet spot. Or this is just 38.2. If you can get, and what I would recommend if you were trading this is you just scale your way out. So by the time you hit this 22.5, you either roll the position out, but keep in mind it's a January 2015, so you got lots of time, with the ultimate target of wanting to take profits up at 32. If this silly thing goes to 32, whatever options you have left, each one is going to be worth $15. So from 50 cents, that's not a bad trade. That's looking at both the long call and short put strategies, specifically talking about options. I've spoken now, I guess, for about an hour and a half. So let me just check in with the room, see how we're doing. Looks like we got a couple comments here. At this point, if anybody is interested in asking a question, I guess we still have Haven here. If you'd like to ask a question, feel free. But basically, that's a summary of my presentation. All right. So since there are no questions at this point, I think I'm going to end the broadcast here. Thank you very much, everybody, for joining me today. Hopefully, I've demonstrated how Brazil looks very interesting from a long side of the market, and I think they have a catalyst here to work with. I've also demonstrated that a number of Brazilian companies are trading at very, very low valuations. The companies we looked at particularly today one was a housing stock, and one's a major oil conglomerate. We've also looked at put option strategies by writing the put, how you can get paid by the market to hold the position on your books. And you're more than welcome to look into the WDB options model further. It's still in beta right now, so you can actually get these reports delivered to you free of charge. All you have to do is just enter your email information and create a password. The second stock that we looked at was... So we looked at PBR, the oil conglomerate. We looked at GFA, the housing stock. We also looked at the Brazilian ETF. We can basically get confirmation from that the broader Brazilian market's moving higher. We looked at the Brazilian real and the bottom that it is, and where some realistic technical targets are going forward. And we looked at the catalyst, what might be driving money flows right at the moment, and that is money flows. Thank you very much for watching my presentation. Joe hopefully will be back next week, and maybe we'll fill the room up a little bit more with some more questions. Because I don't see any questions right at the moment, I'm just going to simply bid you all a fond farewell and adieu, and ask you kindly that if you did see value in this presentation and you'd like to donate, I'm accepting Bitcoin donations, and my goal is to build myself up to a few Bitcoins, and then I can start trading the coins as I trade the rest of these other things. Thank you very much for watching, and by all means, if you have any questions, you can get a hold of me at tradingview.com, or Joe, he is TheChasm. You can follow me on Twitter at CRInvestor, and my Twitter feed, as you can see, is on the front page of my website. And if you'd like to visit the website and learn more about me, feel free. It's therationalinvestor.ca. My name again is Brian Beamish, and this was a real pleasure making this presentation for you all. So have a good night and all the best.